Of watching ET Now. You get the right trends and the right news at the right time. Tarun Kataria joins us, Chief Executive Officer with Religare Capital Markets. Tarun, good morning. Thank you for joining us. Tarun, a year ago when we were discussing markets, there were bears everywhere. Now there are bulls everywhere. Do you think somewhere expectation management will be a key challenge for this year?
Yeah, I think my sense is the markets, it's done a lot over the last few weeks. I think now the macro environment needs to sort of catch up a little bit. So that doesn't mean that the markets are headed south. I think the markets are still headed up for the rest of the year. Global liquidity continues to remain very strong. But at some point, macro has to catch up. And as you know, right now, macro and rates, macro still looks weak. Rates still remain high. Inflation trending down, but still high. So that needs to catch up with the markets right now.
So Tarun, what is your sense? Do you think the fundamental underpinnings and concerns that you just talked about could push the market down, or do you think it's completely liquidity driven right now and we will see newer highs in the next 1 or 2 months?
I'd like to believe that we will continue to see new highs. I think we have a call of sort of 10, 12, 15% up on both the indices for the year, driven again largely by the fact that global liquidity continues to be strong. But as I said, we've seen a lot of I'd be a little rude by calling it noise, but there is a sense that reforms are needed, but domestic reforms need to come through, and that is a gaping hole at the moment. So there's nothing that's changed that would suggest that India Inc. sort of invests in India just yet. So that needs to change. Rates need to come down pretty dramatically, but liquidity is still there. I think the point in all of this is towards the end of the year when global liquidity starts to dry up, and I think that's a fair chance that the $85 billion a month that the Fed is putting into the global system, if that starts to dry up, I hope we have our economic house in order, because then it becomes a little bit tricky. But for now, until then, I think it's reasonably upward from here.
So Tarun, do you think 2013 could be a year of inverted V, which is a strong start and a slow finish?
I think it's possible. I wouldn't call it a V, but it's sort of, I don't know what you call that, but a chart upwards in declining returns, if you will. I think that's very possible. But as I say, the bias, and I am sort of unfortunately consensus here that the bias is to continue onwards and upwards.
So what to your mind could be the ultimate trigger for Indian markets? Because earnings are factored in. The consensus on the street is that Reserve Bank of India will cut rates. The fact that budget will be good is known. So what will really generate upside momentum?
As I say, global liquidity, that continues. India and China will be the two markets of choice for the year in terms of global emerging markets. If you look at the BRIC markets, as I think we might have just discussed this before, Russia is having a share of its problems. Brazil, not as exciting as it used to be. The currency has been too strong. Indonesia, small to really attract massive flows. So the flows will come into India, China. I think, frankly, China will outperform in its GDP growth numbers, which will be generally positive certainly for Indian stocks as well. If I'm going to make an aggressive call, I think India GDP will underperform consensus. So I think until that sort of sets in, as I say, the markets, liquidity-driven markets, the sense that reforms are happening, driven markets, onwards and upwards. And earnings, the market's reasonably fairly priced, right? If you have a 150, 200 basis point rate cut over the next 12 months, blank stocks go, and therefore the index goes as well.
Tarun, how imperative is a rate cut by the RBI month end for the market to actually stay afloat?
Actually, that's a bit worrying, because I think consensus seems to be 25 on its way to 50. And from Subara, at least from his statement last night, would suggest, guys, don't be banking on it because it may not come through. So we'll have to wait and watch. If it doesn't come through, I think you'll have a temporary problem, perhaps a buying opportunity. That's the way I would look at it.
Tarun, in terms of a strategy, Religare as a house is clearly recommending that it's time to move out of the shell, which is it is time to sell defensives, it's time to get out of expensive consumer names, and it's time to revisit cyclicals. But cyclical stocks also in last 3 months have appreciated. Some cyclical stocks have appreciated by 50, some have appreciated by 100%. Do you think the low-hanging fruits in the cyclical or the cyclical stroke tactical trade that they have been plucked?
You've seen a lot of upside, but I think if you look at the cement, like a sector like cement, I think there's some room to go there. The rate sensitives, I think, continue to run from here. So 10% is not a large move. 10 or 12% through the rest of the year is not a large move. I think it's entirely possible in these 2 or 3 sectors. Although obviously you've seen a massive run up in some of them, but I think that continues.
Which means
I think we'd be generally constructive, and I think obviously, sorry.
Please go ahead.
I think you've been reading our research, which is terrific, but that's right. We're moving out of defensives into large cap IT, into cement. Perhaps the technology stocks or the telecom stocks have had a good run, so I think we'd be generally cautious on that. But there are plenty of stocks to pick, plenty of sectors to pick where there's sufficient upside through the rest of the year.
Why do you like cement? Because if I could just challenge your bullish stance on cement with valuations, ACC, Ambuja, Ultratech, these are expensive stocks to own now. Why buy them now after last year's splendid run-up?
I think we've done a lot of, actually one of the great benefits of being within the Religare system is we have access to dealers across India, not just 3 or 4 dealers in one state. So we've just done a dealer check across the country, and it's clear to us that price movement up from here, probably more than the market believes will happen, hasn't been priced into the market as we see it. So most people might think 20 or 30 rupees is sort of pricing power. I think it's probably 2x that, and therefore we believe a lot of these good names, whether it's Shree Cement, whether it's Ambuja, are set to run. The run is set to continue.
Tarun, what's the call on IT after what we've seen from TCS and Infy?
I think our bias is towards large cap IT. The mid cap ITs that we had actually made a call on 7 or 8 months ago have had a tremendous run. But I think from here, probably it's going to be difficult to have tremendous momentum. I think their order book, their margins will be under pressure. So in order to maintain, I think, their revenue run rate, they're going to have to give in on margins, which I think we've seen in 1 or 2 of the small names that have announced their results so far. So the bias for us is very much, sort of the Infy TCS pack as we see it from here.
Tarun, as of now, markets are only talking about rate cuts, the fact that earnings have bottomed out, but nobody seems to be talking about fiscal deficit, current account deficit. I mean, these problems, they still exist, and these problems, they really haunted us last year. The problems have not been washed away, but markets are ignoring them.
Well, you see, that's my point. It's a liquidity-driven market. Global liquidity has a decent chance of drying up at the end of the year. So if we don't have our economic house in order in the next few months, the pressure on the currency can get intense, and that to me is the big risk, for the rest of the year. I think the current account numbers that people are talking about are way below where I think they come out. GDP, I think, comes out lower than what the market is estimating, but that's sort of, that's all back-ended stuff, right? So those are the risks to our numbers. It's absence of liquidity, the currency will come under pressure. So these are the things to think about over the next, I guess, the back half of the calendar year. It will definitely come into focus then.
Final question, Tarun. At a time when you are convinced and clear that it is liquidity which will, decide the script of how Indian markets will move this year, what is the best way to make money when there is abundant liquidity?
I think just, as I say, you can't you can't get in front of this train, ride the good sectors, ride the good stocks. I think that's something to think about. Be careful with what you buy. There are obviously a lot of undervalued, high quality names with very strong governance. I think you continue to own those for the next 3 or 4 months. And frankly, in the middle of the year, evaluate, as we all do in the business, evaluate where we are, which have underperformed, and you rotate. But for the next 2 or 3 months, I think you can be in a lot of the good sectors that we've already talked about.
Good chatting with you. It always is. Let's quickly revisit what the market is up to. Currently lying absolutely flat, 60-50 thereabouts. Reliance, that's your big star in today's trading session. And on the flip side,